Ever wondered how money makes more money? Welcome to the intriguing world of finance and investment, a realm where dollars and cents transform into powerful tools to build wealth. It's an exciting space, but also one that requires understanding, patience, and a touch of daring. Imagine for a moment, your hard-earned money is not just sitting idle in a bank account. Instead, it's out there working for you, multiplying and growing. This is the essence of investing. It's about making your money work for you, so you don't always have to work for your money. Investing is not just for the Wall Street whizzes or the ultra-rich, it's for everyone. From the college student saving for a car, to the young professional planning for retirement, to the parents setting up a college fund. Investing is a journey, a long-term commitment, and the sooner you start, the better. Now let's touch on the different types of investments out there. There's a whole universe to explore, with opportunities to fit every risk tolerance, financial goal, and interest. There are stocks, where you buy a piece of a company and become a part owner. It's like riding a roller coaster, thrilling highs and sometimes scary lows. Then there are bonds. It's like lending your money to a government or a corporation. In return, they promise to pay you back with interest. It's a safer bet, but the returns might not be as high. We also have mutual funds where you pool your money with other investors to buy a diverse range of stocks and bonds. It's a way to spread your risk and possibly increase your rewards. And of course, there's real estate. Buying property, renting it out, watching its value grow over time. It's a tangible, bricks and mortar type of investment. So there you have it, a quick glimpse into the world of finance and investment. Now that we've got the basics down, let's dive deeper into the world of finance and investment. Stocks, a game of risk and reward. But how do they actually work? Let's break it down. Imagine you're at a bustling marketplace, except instead of buying and selling fruits, vegetables, or trinkets, people are dealing in pieces of companies. That's right, when you buy a stock, you're actually purchasing a tiny slice of a company, becoming a shareholder. Now, why would you want to do that? Well, as a shareholder, you stand to benefit from the company's success. If the company makes a profit, you might receive a portion of those earnings in the form of dividends, or the company's stock price may rise, and if you decide to sell your shares at that point, you'll make a profit. But it's not always a smooth ride up. Just as you can profit from a company's success, you can also lose money if the company doesn't do well. If the company suffers losses, the stock price may fall, and if you sell your shares at a lower price than what you paid for them, you'll end up with a loss. That's where the risk comes in. The stock market can be unpredictable, with prices fluctuating due to a variety of factors, from global events to changes in the company's management. That's why it's crucial to do your homework before investing in stocks. Market research is your compass in this sea of uncertainty. It involves studying the company's financials, understanding the industry it operates in, and keeping an eye on economic trends. It's about making informed decisions, rather than just following the crowd. To sum it up, investing in stocks is like a high-stakes poker game. You're betting on a company's future performance, and the stakes can be high, but with careful planning and diligent research, you can tilt the odds in your favor. So stocks can be a gamble, but with careful planning, the rewards can be substantial. If stocks seem too risky, how about a safer bet? Ever heard of bonds? Bonds, my friends, are essentially IOUs. When you buy a bond, you're lending your money to an entity, like a corporation or government. In return, they promise to pay you back the amount you lent them, known as the principal, at a specified future date, also known as the maturity date. But here's the sweet part. As a thank you for lending them your hard-earned cash, they also pay you interest periodically. Now, you might be wondering, why are bonds considered safer than stocks? Well, it's because of this promise to pay back the principal and interest. Even if the entity issuing the bond faces financial difficulties, bondholders are usually the first to get their money back. This is unlike stocks, where if the company goes under, shareholders may end up with nothing. But of course, just like any other investment, bonds do come with their set of risks. One of them is interest rate risk. You see, there's an inverse relationship between bond prices and interest rates. When interest rates rise, bond prices fall, and vice versa. So, if you decide to sell your bond before its maturity date and interest rates have risen since you bought it, you could end up getting less than what you paid for it. However, bonds offer a steady income stream. Those periodic interest payments can be a nice addition to your income, especially if you're looking for a more predictable and less volatile investment. While bonds may not offer the high returns of stocks, they do provide security and stability. They are a good option for those looking to preserve capital and generate consistent income. So, if you're the type of investor who prefers to sleep well at night, knowing your investment is safe and generating a steady income, bonds might just be your cup of tea. Bonds, a safer bet, providing a steady income, but with lower returns. And remember, the key to successful investing is diversification. A mix of different investments, including bonds, can help you achieve your financial goals while managing your risk. Not a fan of putting all your eggs in one basket? That's where mutual funds come in. This old adage rings true, especially in the world of finance and investment. Mutual funds, my friends, are the financial equivalent of a well-rounded, balanced diet. Let me explain. Imagine you're at a buffet, a financial buffet, if you will. Now you could load your plate with just one dish, say the tantalizing stocks or the comforting bonds. But what if you have too much of the same thing and it turns out to be less enjoyable than you expected? Or worse, gives you a financial upset? Well, that's where mutual funds come to your rescue. They give you a little bit of everything. A bit of stocks, a helping of bonds, a slice of short-term debts, and so on. This is what we call diversification, and it's the primary reason why mutual funds are so popular among investors. Diversification is all about spreading the risk. When you invest in a mutual fund, you're not just investing in one company or one sector. You're spreading your investment across a variety of stocks and bonds from different sectors. This way, even if one sector or company doesn't perform well, the others can compensate for it. Think of it as having a safety net. Yes, investing in mutual funds might not give you the adrenaline rush of betting it all on one stock. But it does give you a sense of security, and in the unpredictable world of finance, that's something we all could use a little more of. So, how do you choose a mutual fund? Well, that's a topic for another day, but what's important to remember is that mutual funds are managed by professionals. These are people who spend their days analyzing market trends and making informed decisions on where to invest. So, whether you're a seasoned investor or just starting out, mutual funds can be an effective way to diversify your portfolio. They allow you to benefit from a variety of investments without having to manage them all individually. Mutual funds, a great way to diversify your investment and minimize risk. Looking for a tangible investment? Consider real estate. There's something comforting about investing in bricks and mortar, physical properties you can touch, see, and even live in. When you invest in real estate, you're buying more than just a plot of land or a building, you're buying potential. Real estate investment can provide a steady income through rent. Tenants pay a fixed amount every month, giving you a consistent revenue stream, but the benefits don't stop there. Over time, the property itself can appreciate in value, increasing your wealth without you having to lift a finger. And unlike stocks and bonds, the value of a house or a piece of land doesn't fluctuate wildly from day to day. Real estate also offers opportunities for diversification, allowing you to spread your risk across different types of properties and locations. So if you're looking for a stable, tangible investment with the potential for steady income and growth, consider real estate. Real estate, a tangible asset that can provide a steady income and potential for growth. We've explored various avenues of investment today. We've seen the adrenaline-fueled world of stocks, where the potential for high returns is as thrilling as it is risky. We've delved into the calmer waters of bonds, a safer bet for those who prefer steady growth over time. We've navigated the diverse landscape of mutual funds, where the key is to spread out your investments, reducing risk and increasing potential gains. And lastly, we've stepped into the tangible realm of real estate investing, where the bricks and mortar of properties can offer a solid foundation for your financial portfolio. Each of these avenues has its own unique benefits and challenges. The wisdom of investing lies in understanding these and making choices that align with your financial goals and risk tolerance. Remember, investment is all about balance. Make informed decisions and you'll see your money grow. Before we wrap up, we would like to remind you that the journey of finance and investment is a continuous learning curve. We're here to help you navigate this intriguing world. If you found our content insightful, please give us a thumbs up and subscribe to our channel. Your support helps us create more of the content you love. And don't forget to hit the notification bell to stay updated on our latest videos. Remember, your journey to financial freedom starts here. Thank you for watching, and as always, invest wisely.